In this video, we are going to take a look at a way that companies can reduce their borrowing costs. It's quite a clever way. It's called a swap. Sadly, it's not something that's directly available to retail investors because the amounts involved is fairly large. So what we'll do is take a quick look at a swap, how it works, how banks make money from it, and also one or two of the applications. And we're going to focus on interest rate swaps. Interest rates are changed by central banks all the time to meet GDP growth and inflation targets of their country. Currently, they are expected to have topped out and now are on the way down. The Bank of England, US Fed, and other central banks are expected to slash interest rates this year. The only question is when. Okay, so what is a basic swap? Well, imagine you've got a company, and for the sake of argument, I'll just call Thema Company A. And just to demonstrate how a swaps bank makes money, I'll have two clients in my example. So Company A and Company B. And a bit like you or I, they need to borrow money in order to expand. They need 10 million each. Just like you might apply for a mortgage, and they have different views about interest rates. So Company A would like, ideally, to borrow at a variable rate of interest. Perhaps they feel that interest rates are on the way down, and Company B would like to pay a fixed rate of interest as they prefer certainty of their payments rather than trying to benefit from interest rate movements. And that's a bit like the mortgage or home loan market. Some people like a fixed rate of interest over, say, 5 years. Some people are happy to take a variable rate of interest over the same term, and banks have to cater to both types of mortgages. So remember that Company A's aim is to pay variable interest on the money it borrows. It's going to borrow $10 million, but Company B would like to pay fixed interest on the money it borrows. And it's also going to borrow 10 million. And these two companies don't actually know each other. And we'll see how an investment bank can improve both their lives by using a swap deal. Okay. So Company A goes to its bank, which rather unimaginatively I'll call Bank A. Company B goes to its bank, which I'll call Bank B. And basically, here are the terms on offer. Now, Company A is big, well-known, well-established. Company B, little bit smaller, finds it harder to raise money. So Company A goes to its bank and is offered the following. The bank says, if you want to borrow 10 million from us and pay a fixed rate of interest, you'll pay us 7%. If, on the other hand, you'd like a $10 million loan at a variable rate of interest, you can pay us the secured overnight financing rate, in short called SOFR. Now that's a variable rate which has now replaced famous or rather infamous LIBOR. For now, just remember that SOFR is a variable rate that can potentially change every day. If you want a detailed video on SOFR and other LIBOR replacement rates, then let us know in the comment section. But the important thing with this example is that SOFR is variable rate. So the fixed rate of 7 won't change over, say, 5 years. SOFR might, depending on what happens to the bank and the base rate. Okay, the Company B goes to its bank. Now Company B is less well known. That's life, it's smaller. It doesn't have the clout of Company A over here. So the bank says, well, if you want a fixed rate, you'll pay us 10%. And if you want a variable rate, you'll pay us SOFR plus 1. So whatever SOFR is, you're paying us 1% or 100 basis points over SOFR. So if in 3 years' time SOFR is 8%, you're paying us 9. If in 5 years' time SOFR is 10%, you're paying us 11 and so on. Or you can just take a fixed rate. So you get out of bed in the morning, you know exactly what you're paying, but that's 10%. Take it or leave it. Okay, now you might think, Company B wants a fixed interest loan, so it just takes the 10%. Company A wants a variable rate loan, so it just agrees to pay so far on 10 million. But actually, and you may be able to see what's coming, there's a way for an investment bank, which I'll pop in here, to help both of its clients and make a bit of money for itself at the same time. And here's what's going to happen. Despite wanting to pay a variable rate, let's assume, and this is a slightly artificial conversation, but it'll get us through the example and show how the whole swap can help everybody. Let's assume the conversation goes like this. The investment bank says, to Company A, I know you'd like to borrow 10 million at a variable rate, but actually, when you take out a loan with Bank A, what I'd like you to do is the exact opposite. So by all means, take a loan from Bank A for 10 million, but pay Bank A the fixed rate of 7%. Then it goes to its other client, Company B, and says, I know you want to borrow at the lowest possible fixed rate, but bear with me, go to your bank and take out a loan at the variable rate. So, in other words, go and get the money you need from Bank B, $10 million once more, but pay them the variable rate of SOFR plus 1. So, what you have so far is two companies. They've taken out separate loans, both for 10 million, with their own banks, and at the wrong rate in both cases. So, how can an investment bank give them the rate they want and reduce the cost of it? Here's the answer. Okay, now I want to make up a few numbers here. These don't have to be the exact numbers, but let's say, for example, and here come the two swaps. Why two? Because it shows how the bank can make some money and also help two clients, and it also shows how the bank can sort of offset risk on each side. So let's say the investment bank says, right, I'm going to do a swap, a separate deal with each of my clients. And these are separate swaps. So there's swap 1 and there's swap 2. And literally a swap is just exchanging one thing for another. In this case, interest rates. So the swaps bank says, okay, Company B, you've borrowed 10 million from Bank B. You don't need another 10 million from us. You just want to change the interest rate you're paying on that loan. You're paying a variable rate and you'd rather pay fixed. So without borrowing another 10 million, let's agree a swap just for the interest on what's called a notional amount of 10 million. In other words, we're just going to swap the interest payments you're committed to, nothing else. We're not giving you another 10 million. That'd be 20 million. You don't need another 10 million from us. You just want to change the interest payments from variable to what you originally wanted, i.e., fixed. So basically, here's the deal. The swaps bank says, on a notional 10 million, we'll pay you SOFR and you can pay us 8.5% fixed. Then it goes to Company A and says, we'll do a deal with you, another swap. Basically, you pay us SOFR and we'll give you 8% fixed. So think of swap with both companies as no new cash changing hands, no additional 10 millions, just an agreement to swap the interest payments on what's called a notional amount of 10 million. In other words, every, let's say 6 months, the swaps bank will settle the difference with Company B between SOFR and 8.5% on 10 million, and every 6 months, it'll sit down with Company A and swap the difference in interest terms between the SOFR rate and a fixed 8% on 10 million. So that could mean, depending on what SOFR does, which is a variable rate, Company B could be paying investment bank or vice versa, and the same on this side. Now looks complicated, but actually here's the bit of financial magic. If we look at cash flows for all the parties, most of all, the investment bank is making money. It receives 8.5% from Company B and pays 8 to Company A. It pays liable to Company A and SOFR to Company B, both on $10 million. So basically, whatever SOFR is, 10 million times SOFR flows in and flows out, and 8.5% on 10 million comes in, and only 8% goes out. So the swaps bank is making 0.5% as its profit, and 0.5% of the big number is worth having. And it'll make that 0.5% even if the variable rate was 20%, because 20 comes in, 20 goes out. So that's neutral, but it still makes the difference between 8.5% and 8% provided Company B keeps paying over the term of the swap. Let's say 5, 10, 20 years, it'll make that 0.5%. Now, what about its clients? Are they happy? Company B wanted to pay the lowest possible fixed rate. The bank B offered it 10% as lowest rate. Now with the swap, look what's happened. Basically, SOFR cancels out, because whatever SOFR is, it comes into Company B on 10 million and goes out on 10 million, leaving plus 1%. So what is Company B effectively paying on its original 10 million loan from Bank B through a combination of the interest agreement with Bank B on the swap? And the answer is 8.5 plus 1 or 9.5% fixed, and 9.5% fixed is less than 10% fixed. Half a percent might seem small, but half a percent on 10 million is quite big. You might think that's not much, but on 10 million over say 10 years, that's worth having. And A, on the other hand, always wanted to borrow 5 million at the lowest possible variable rate. Its bank said, if you come to us, you'll be paying us the SOFR rate. That's the best we can do. As a result of the swap, where is it now? And the answer is paying SOFR to the investment bank, but receiving 8% on 10 million and only paying out 7 fixed. So given that's a fixed 1% saving on 10 million, in effect, Company A is now paying SOFR for the whole term of the loan minus 1%, and that's better than paying SOFR, and that is the point of the swap. Ultimately, Company A is now paying a variable rate of interest, which is lower than it could have gotten from its own bank. Company B is paying a fixed rate of interest, which is lower than it could have got from its bank. And it works because of something called comparative advantage. What the investment bank does, because it knows both clients, is they are able to borrow at different terms. Just as you and I borrow at different terms, the terms for loans and mortgages and so on can vary depending on the size of your deposit, your credit history, and so on. And that's the same for companies. All the investment bank's done is to spot the gap and make a bit of money for itself by setting up two swaps with its clients. Now, I've made that sound very simple, but there are some risks. If Company A or Company B go bust, you've got a problem. So the investment bank needs to be fairly sure that both clients are capable of meeting the obligations under the swap. It might take some security from them. It's called collateral. And you might think, how does this help me in the retail market? Well, the answer is swaps do help to bring down borrowing costs for everybody. So, not just for companies, but on mortgages. But unfortunately, if you're thinking, well, you know what? I'm paying a variable rate mortgage right now, or I really wish I could swap that for a fixed rate as interest rates rise. Sadly, your mortgage probably isn't worth enough to an investment bank to arrange an interest rate swap. The economics just don't stack up. You'd have to cancel your mortgage and start again if you like. And that's probably something that's prohibitively expensive, but it's worth bearing in mind that the existence of swaps is one of the reasons why mortgage rates aren't potentially higher than they otherwise would be. Now to end the session. By now, I think you would be able to appreciate number one, that swaps are efficient when one party has a competitive advantage in a fixed rate market due to its large size and very good credit rating, as banks typically will prefer giving variable rate loan as they are less risky because there is no market risk, i.e., loss due to change in interest rate. So fixed rate loans at a decent rate of interest are generally only offered to a customer that has good bargaining power due to the size and strength of its balance sheet. Otherwise, you would have to pay quite a high rate of interest if you want to get a fixed rate loan. Number two, cost of doing such financial engineering is justified only if notional size is very big as profits earned is only a fraction of percentage. Hence, swaps are not available for retail clients. Alright everyone, that's all for this session. If you liked this video, then please like, share and comment on this video and also subscribe our channel for more such videos.